Hello there, I'm Tom Katzis. I'm a health insurance broker in Los Angeles, California, and I work a lot with long-term care insurance policies. A long-term care insurance policy is a policy that will pay you to be taken care of when you are losing some of your activities of daily living, like bathing and being fed and having control of your continence, and if you're ambulatory or not. Well, there are different types of long-term care insurance policies. A big comparison would be between what we call a tax-qualified and a non-tax qualified long-term care insurance policy. A tax-qualified long-term care insurance policy would say to you, you give us premium every month, we're the insurance carrier, and if we have to pay you claims in a few years down the road, you won't be taxed on that monthly benefit of $3,000, $4,000, $5,000, $6,000. So that's a big advantage for people to consider when they're looking at long-term care insurance, to make sure that if it's a tax-qualified plan, they're not going to penalize you because suddenly you need to be collecting that money, which you would need every dollar of that. Another type of long-term care insurance policy would what we call indemnity. Now, this is going to be a little bit more involved, but I think you might want to know about this. If you buy a policy that's going to pay you $5,000 per month, and you lose some of your activities of daily living, the policy is triggered. You're going to start collecting this $5,000 a month, and you're being taken care of by family at home, which you can do with a home health care rider. Well, let's say that particular month, it only costs the family, with nurses coming in, doctors coming in, $2,950 that month to take care of you. The insurance carrier is going to send your family the full $5,000 because it was an indemnity plan. You're being indemnified for the amount of the policy you bought. Now, let's compare that with a reimbursement long-term care insurance policy. By the way, the premium for a reimbursement style policy will be less money. It's a little bit less expensive. Why? That same example, you've got a $5,000 benefit, but it only costs $2,950 to take care of you that month. The insurance carrier is going to write you a check for $2,950. They're going to reimburse you for what you spent. The last couple years, most of your major carriers are really only selling the reimbursement type plans to kind of help with reserving for future losses as well. They have come up with a couple wrinkles where you can buy a cash benefit rider so that you could have, let's say, a $5,000 policy, but a guaranteed cash rider of $3,000 a month if you want to pay a little extra premium. We're getting pretty involved here, but I've given you some of the highlights. Thanks for watching. I'm Tom Katzis.